Hello, everyone, and welcome to the Vegas Legal Magazine podcast. I'm Mark Fierro with Tyler Morgan, publisher of Vegas Legal Magazine. Thank you so much for joining us today. Whether it's snowing in Texas or the sun is shining in Las Vegas, one season that all of us have to sit through is tax season. In the past year, the economic climate has changed so much that many Americans' incomes, their financial situations are all up in the air. As this tax filing deadline looms, there are topics that many of us are having to deal with for the very first time. Here to talk about this unique tax season and how your taxes are affected by everything from PPP, stimulus checks, to a surge of income from Bitcoin or GameStop, Donovan Thiessen. Thank you so much for joining us today, Donovan.
Thank you for having me.
So I know this is the first time that you've heard this, but what do I do with PPP money? Is it a loan? Is it income? It's the very first time you heard it, right?
Right. That's a good question. It's a great way to start. Great way to start today. So PPP was a program that launched last May, and it was designed as a federal stimulus to help people sustain their payrolls during the shutdown. And what's happened with that is at the end of December, they actually finalized some of the rules and some of the open-ended questions that weren't quite resolved. And just in the last 2 or 3 weeks, they've actually released out some of the forgiveness applications that are you're actually now able to complete the simplified forgiveness applications through your banks. And the main pool of people that were greatly affected and benefited in the legislation that passed at the end of 2020 had to do with people who got PPP money less than $150,000. So if you received a PPP loan under that amount, you're able to do a streamlined application through your bank. Some banks still don't have the forms available, but most of them do. And what it is it allows you to do a one-page application versus a multi-page application. And there was quite a few questions and calculations to go through. Now it's a simplified application that basically just asks you, did you use the funds to maintain your payroll for the time period, the covered period as they're calling it? And you submit the application, and the way I've seen it is that the applications are going through quite quickly. For loan amounts over $150,000, there's still a few hoops to jump through. But to answer your question, it is not income. It's not. There were some questions as far as the expenses that were paid, particularly payroll and rent. Would those be able to be deducted for 2020 taxes? And the answer is yes. You're not going to be hit with extra income on that money that you received.
Wow.
It was a very big question, and that's been resolved now. So the only question that might actually still be out there, though, is there were a few people that applied for and received forgiveness in 2020. But if you still have these loans on your books for 2021, then I'm looking at this as an accounting question and a tax question that needs to be dealt with in 2021, even though the cash was really used for expenses in 2020. It's still a conversation I'm having with my clients in 2021 if the forgiveness is happening this year.
So are you saying clients who got PPP money but didn't exhaust all of it in 2020 and they still have some left over?
So everybody that got it, they used it all within the covered period. But what's happening is the accounting function, though, still shows a loan that hasn't been forgiven on their books. So they got the cash, they used the cash, and they qualified for forgiveness for having used the cash in the correct period in 2020. But it's still technically a loan on the books in 2021. So it still needs to be dealt with from an accounting standpoint in 2021. Not a big deal. It's just kind of finishing out part of the conversation as it hits my desk.
Interesting.
So I have to imagine that the new round of questions is, how do I apply for the next round of PPP money? Because obviously Nevada's still getting hit pretty hard.
Yeah, so that's where we're at now. The application started about a month ago. for PPP2. That's what we're calling it. And the criteria is pretty simple. Basically, you look at your income statement. If you don't have an income statement, you add up all the gross receipts. We're really focused on gross receipts. And what the criteria is for any quarter in 2020 compared to the same quarter in 2019, if you have gross receipt reductions of 25% or more, you can qualify for the PPP2.
Wow.
That's what they're looking for. They're not looking at the expenses. They're only looking at gross income decline of 25% or more for quarter to quarter, 2020 to 2019. It can be any quarter. So if it's the first quarter in 2020 that you experience a 25% decline in over the first quarter in 2019, then that's your green light into PPP2. And the rest of the rules are pretty much the same.
So I have a question.
Go ahead.
Okay. So using like a law firm, for instance, like a personal injury firm, some of these firms, their revenues may increase during 2020, 2021 because they're settling out files from years prior, but maybe they're not retaining as many new clients each month. Is there some sort of calculation that works differently for a business that operates that way?
It's all cash receipts.
Okay.
So it's, I guess, well, we've been dealing with cash basis. So without getting too complicated into this answer, I deal mostly with cash basis taxpayers, which means cash in the bank. But from an accrual standpoint, that's kind of what you're referencing. So there might have been income earned in prior periods that's not paid out until later periods.
Correct.
Yeah, I mean, if you're on an accrual basis, you've maintained an accrual basis, that might be something that we can look at, after the call. But so what they're looking at is they're looking at an income statement by the quarter, and they want to see gross revenue down by 25%. So on an accrual basis, that could happen. I understand what the question that you're asking. I would just need to know like a more specific set of facts, and then we would look at the more specific rules to see if that's something that would qualify.
I saw an article in the RJ today or yesterday. They said they're putting more emphasis on small businesses.
Yeah, so that is, I also read the same thing. Biden made an announcement, President Biden made an announcement in the last few days, and they're trying to assist more, it sounds like applicants that might not be as savvy or might not have access to an accountant or a CPA, but they do need the funds. That's the best way to put it. So they're trying to open up the channels there to where they can get, in particular, minorities and smaller clients that just might not have that access into these stimulus funds. They're trying to open that channel up. But one of the other notes that I saw in that is that they're also trying. There's some rules where if you had any kind of a criminal record, that you would be prohibited from getting PPP funds. They're trying to open that up a little bit more to where if you have misdemeanors that are not fraud related, now you can get your foot in the door. And I think that was one of the points that they were making this week on that there
Have they done anything about businesses that were newly created shortly before COVID started?
So there are rules. So the main rule is you had to be in existence as of February 15th, 2020.
Okay.
So that's like a big rule. If you weren't in business already by that point, you're not going to get very far. But as long as you were in business at that point, you can get your foot in the door, and you can, even for PPP2 does have different rules than PPP1, but one of the things that opened up in this recent window with PPP2 was they reopened the ability to apply for PPP1 if you hadn't already done that. So that's where your question would come into play, is as long as you're in business by February 15th, 2020, and you hadn't already applied for a PPP1, there might be opportunity for you to do that now.
Okay.
A couple years ago, Bitcoin, what's this crazy stuff? This is worthless. You're throwing your money away. Today, not so much. Now it's become a currency. It's a standard currency. You buy it at the gas station now. What's happening with your clients?
Yeah, it's a great question. So I've been preparing tax returns for Bitcoin and cryptocurrencies since all the way back in 2014. My first client that approached me with this, they were buying it at $7 and $8, and at that point in time, this was for tax year 2013. It spiked to $300, and so this is somebody they were buying it at $7 and $8. It spiked to $300, and as we were preparing the taxes the following year in 2014, it was spiking up to $1,000. So it was really interesting. I'll just share this brief story and then answer your question. But I remember at the time he held a lot, more than 1,000 units, and we wrote a letter at the end of the tax prep. Now I don't normally give financial advice, but this thing sounded like I needed to take a slightly different move at the end of the tax return. I just wrote him and I said, you're probably wise to diversify this because we're just seeing so much volatility. So anyway, as the years went on, I continued to work on these sorts of clients. And over the years, we've seen a lot more IRS scrutiny on this activity. And what a lot of people don't know, a lot of people own it now, is there needs to be really good accounting records maintained for these purchases and sales. 1099s haven't been given out until the last year or so. Coinbase was the first one to start issuing 1099s on documenting the proceeds for sales for its users. This year was a big year. If you look on the Form 1040, your individual tax return, on the very first page, just below your name and address, there's a new question, and it says, at any point in time, did you buy, sell, trade, exchange any cryptocurrencies? Yes or no?
Wow.
And so, as you know, when you sign the dotted line on your tax return, it's under penalties of perjury. So that's the first time we've seen that question pop up, and it is there. It's on, no lie, it's on the first page, right below your name and address. Wow. So I want to comment briefly on this because it's really important. More and more people have this, and it's a question I have to ask every single client now to make certain that we're not, making improper statements or incomplete statements on the tax return. So cryptocurrencies are treated as property. It's treated as a capital asset, which means that when you buy and sell it, you report it in the same place you would report a stock sale.
I was just going to say.
Yeah, it's right there. It's on Schedule D. And in order to properly report this, you have to maintain your purchase history and exchange history, and then of course your sale history. And what happens is that your accounting should look like a first in, first out format. You have options, but most people do first in, first out. What that means is if you bought some Bitcoin a few years ago and then you sold some last year, let's say you bought 200 units a few years ago and you sold 10 last year, we assume that you sold 10 units of the very first units that you bought. And so we look at the units, when you bought them, and how much you paid for them, and we subtract that off of your inventory. So you're always keeping track of your inventory and your cost basis. Now that sounds fairly simple, I believe, but if you took any of that Bitcoin and you exchanged it for a different kind of cryptocurrency, if you took any kind of cryptocurrency, exchange it for a different type of cryptocurrency, your cost in that new cryptocurrency it has to do with your original cost of the cryptocurrency you bought and you used to exchange it. And that can become very complicated if you're not familiar with the rules that I'm broadly describing here. If you're not keeping track of it, it can be very complicated to put that story together in Excel in an accounting spreadsheet, sometime after you've done all that.
So you're always using the oldest as your basis.
Yeah, so you're always selling your oldest stock first, and that's so yeah. And in this case, your oldest stuff is going to be at a low basis comparatively speaking, but that's what I see missing most of the time. That's the hardest part of doing Bitcoin, is really making sure that we understand, when did you buy it, how much did you pay for it, and how much do you hold now? How much do you hold at December 31st, 2020? How much did you hold on December 31st, 19? We keep track of your inventory, we keep track of your cost basis. And I don't, if you've done exchanges, which many people have, that process can be difficult to follow, especially if the records aren't clear.
The flip side of that, the opposite end, there are a lot of people, well-moneyed people that have worked every single day of their life, that got hit over the head when Mr. COVID arrived, and they just flat lost their jobs overnight. I'm sure that a lot of people, particularly in Las Vegas, are looking at what they received in unemployment for the first time in their lives, even though they may be well into six figures for the first time in their life. How do you treat unemployment? A lot of people have never heard of unemployment until they get shoved with this.
Yeah, that's a good question. So unemployment income is taxable. Federally, if you received income from Nevada as unemployment, it's taxable. If you received, I had a new client just the other day. They moved here from California. They received unemployment income while they were in California. They live here in Nevada. So they live here in Nevada half the year in 2020, and they lived in California the first half of the year in 2020. So they're going to have to file a part year resident California return. They have to file that unemployment income as California source income. And then I don't believe they got Nevada unemployment, but had they gotten Nevada unemployment, that would be taxable as well. So hopefully people did some federal withholding on their unemployment, which a lot did. So that's taxable income. The hope is that the federal withholding that was applied will take care of it. But there's a new layer to that question that's very concerning to myself, as well as many others here. So there's been a big time national issue of unemployment benefit fraud. Every state is dealing with it. The IRS is aware of it, but there are people now receiving basically 1099s for their unemployment income for income they never got. Somebody filed a claim fraudulently, and now they're having to deal with a fraudulent unemployment claim. So this is a real thing. I know people that have gotten this, and I think it's going to become an issue, particularly for the class of people that got these forms, or they're going to get these unemployment forms showing income that they never received. And so, to answer your question, on one side, you do need to report unemployment income as taxable income on your 1040. But if you receive a form for unemployment and you never filed for unemployment, you're going to have to take a few additional steps to contact contact DETR, the Department of Employment Training and Rehabilitation here at Nevada, and request that they correct the 1099. And if you have that kind of an issue, then you might also have a identity theft issue. So you probably want to check your credit report, and this is a big headache. So
wow.
That's what's going on in that area. It's no fun. And I will tell you that I received a notice from DETR that I had applied for unemployment when I did not. So I know this is happening.
Donovan, I wanted to ask you real quick on deductions, because I know there was some talk toward the later part of Trump's presidency about the entertainment and meals deduction. I think they were talking about bringing back the entertainment deduction as part of a way to get us back together. What's the status on that? Because I know that's an important deduction for a lot of business owners, but are there other deductions that came out or maybe are in discussion that are going to sort of look to help out small businesses with deductions, kind of get things rolling again?
Yeah, so there was a change. There was a large change made where, Yeah, you're right. In the beginning of 2018, with the Trump tax reform, they eliminated the deduction for entertainment, which would have been like if a company bought hockey tickets or football tickets. A lot of companies did buy Raiders tickets. You cannot deduct that for business expenses. You know, you can pay with it in cash, but it's more like a personal expense. They didn't change that, so those are still non-deductible. But in an effort to help the restaurant industry, they're now allowing for 100% deduction for meals.
Okay.
And meals has historically been a 50% deduction. So if you take a client out to dinner, it's got to have a business purpose. But you take a client out to dinner, in the past it was 50% deductible. Right now it's 100% deductible. So that was a new one that came into play here just in the last few months. So yeah, that's the best answer I have for you. Otherwise they don't.
And with meals, I know you mentioned it's got to be for business purposes, but isn't there like a caveat where it's sort of assumed to be business purposes if it's over a certain value?
There's no dollar amount.
No. Okay.
No. So it's just a matter of documenting what the business purpose was. If it was to discuss a contract, if you were discussing a new engagement with the client or a review of the engagement, it's as long as it has a business purpose, you're okay.
Okay.
I will say that not many people do this, but it's a detail inside your question. If you do take a client to a hockey game and you buy like a meal item there, if you have drinks and some food, and you are also discussing business, you can deduct 50% of that cost.
Okay.
So
but
depending on
50% of the ticket.
No. Yeah, I wish. I know that was a big. That actually I had that conversation a lot in 2018 and 19 as the Raiders seats were getting sold to businesses. Everybody was thinking that they would do it just like they had in prior years, but they haven't been able to do it.
Yeah.
We don't see a lot of skateboards on Wall Street, but GameStop, look, I had got a few players in there that had never made an investment before in their lives. Are you hearing about any of those? Just one more giant beta to go along with all the other weirdness of last year. You hearing any money that was made in that?
Not too much. No, I haven't heard too much. I heard something the other day. It wasn't GameStop related. It wasn't totally GameStop related. It was Tesla related. Oh, wow. Or we had I have a client who, he made a mistake, and I guess I bring it up in the context of maybe this would apply to your question, or maybe it's a cautionary tale to people who actually own GameStop but anyway, he bought a bunch of Tesla stock in 17, 18, and 19. And I don't know what he was thinking, but he sold it and then he rebought it. And sometimes people do that. Sometimes they sell it and they rebuy it, or it's kind of a day trader type function. But he has $150,000 in gains now. And he used all the proceeds to rebuy the stock. Well, now we have $150,000 that's going on the tax return as gains. So he's got to either come up with additional cash to pay for the tax, or he's got to liquidate some positions in his portfolio to cover that tax. So that some version of that story might come up, but yeah, that was a wild ride. A lot of people got burned on that GameStop deal.
Yeah. So if there's a moral to all of this, weirdness, there's a direct correlation to get to your CPA early as possible, and hopefully they come to you, right?
That's right. Yeah, the best thing to do is to communicate with your CPA, whoever that may be, myself or whoever it is. I can't tell you how many times, if we're keeping the accounting for a client, we have a lot of clients doing deals where they don't tell me about it until it's too late. We might have helped you structure it in a different way. We might have told you don't do it because these financials don't look very good. There's so many different conversations that I've seen that I just wish people would have called me before they did it. So Yeah, I try to identify some of those clients with those propensities, and I try to say, let's have a monthly call where I just want to know where you've been, where are you going, who are you talking to, right? Any big checks lately, and try to get in front of those conversations. Absolutely, that's a good point.
Well, I hear you, and believe me, I feel your pain, and your client's pain from all of the above. Thank you so much for taking the time today, and I know that these are tough days for you with tax day coming up, and so it's not exactly free time that you have floating around these days.
I appreciate you having me on. It keeps me on my toes, and I'm happy to do it again. Thank you.
Thank you so much, and we will have you on again. Thanks again. Thanks again. The Las Vegas Legal Magazine podcast. Sincerely want to thank Donovan Thiessen, CPA, contributor to Vegas Legal Magazine, Tyler Morgan, publisher of Vegas Legal Magazine. Remember to like and share the Vegas Legal Magazine podcast on Facebook, and also catch us on YouTube, iTunes, or Stitcher. For all of you out there with a story idea, a story, or an axe to grind, get a hold of Vegas Legal Magazine, the leading magazine in Southern Nevada legal market. You can call Tyler Morgan at
702-222-3476.
Reach out, tell your friends. Have a good one. We're out of here.